Your money-making broadcast starts now. Evening markets closed with a ferocious tech rally that masked broad weakness across most other sectors. The S&P 500 finished at $737.62, up 0.83%, but that headline number hides a deeply split market. The Nasdaq 100 surged 2.34%, driven by an absolute explosion in semiconductor stocks for a second consecutive day. The Dow Jones barely budged at plus 0.04%, and the Russell 2000 gained just 0.68%. The VIX ticked up to 17.19, implying there is still plenty of anxiety beneath the surface. The story of the day is a three-way drama: semiconductors are on fire, oil is crashing on Iran peace hopes, and healthcare is getting hammered. For Canadian investors, this creates both opportunity and risk. The TSX energy sector faces real headwinds as crude retreats on geopolitics, but the tech-heavy Nasdaq rally offers a lifeline for Canadian portfolios with U.S. exposure. Let's break down every angle. Let's start with the semiconductor story because it is the dominant market narrative right now. Micron technology absolutely exploded today, surging 15.49%. The market is pricing in a memory chip supercycle driven by AI data centers that need massive amounts of high-bandwidth memory. Micron is the primary beneficiary of this trend, and today's move confirms the market sees a multi-year demand cycle ahead. Intel followed with another massive day, gaining 13.96% for its second consecutive day of double-digit gains. 2 days, roughly 28% upside, and a complete re-rating of the foundry narrative. Advanced Micro Devices was not far behind, climbing 11.44%. The Philadelphia Semiconductor Index is now up over 5% in just 2 sessions. This is not a one-off pop. This is a structural repricing of semiconductor assets as the AI build-out accelerates. The legendary growth stock investor, Phil Fisher, would recognize this pattern. He would focus on the underlying fundamentals rather than the price action. Fisher famously argued that the most profitable investments come from companies undergoing genuine business transformation that the market has not yet fully understood. Intel's foundry pivot, Micron's memory chip dominance, and AMD's data center GPU roadmap all fit that framework. For Canadian investors, this matters because the TSX does not have direct semiconductor exposure, but the multiplier effect on Canadian tech suppliers, industrial automation names, and power infrastructure companies is significant. When chip companies spend billions on fabrication plants, Canadian industrial and energy companies benefit indirectly. Now let's talk about what is happening outside of tech, because the divergence is striking. Technology stocks as a sector, tracked by XLK, surged 3.44% today. Every other sector was red. Financials fell 0.6%, dragged down by Wells Fargo, which dropped 4.45% on renewed concerns about its regulatory overhang. Energy lost 0.45% as crude oil prices slid on reports of progress in Iran ceasefire negotiations. Healthcare was the worst performer, down 0.85%, with Pfizer hitting new lows and Lilly losing another 2.72%. This is a market that is rewarding one thing, and one thing only right now: artificial intelligence exposure through semiconductors and networking. Everything else is being sold. Cybersecurity held up relatively well, with Palo Alto Networks gaining 5.78% on continued demand for enterprise security infrastructure. Cisco Systems rose 4.96% as the networking giant benefits from the AI data center build-out. Cisco's routers and switches are in every major data center, and Canadian enterprises from Toronto to Vancouver rely on Cisco infrastructure. This is the theme: AI infrastructure spending is the only game in town, and it is lifting names that investors had written off as mature, slow-growth businesses. The oil story deserves special attention for Canadian investors. Crude oil is falling on genuine geopolitical progress. Iran ceasefire negotiations are reportedly advancing, and the market is pricing in the possibility that Iranian oil returns to global markets. This would increase supply at a time when demand concerns are already simmering. For the Canadian energy sector, lower oil is a direct headwind. Suncor Energy, Canadian Natural Resources, and Enbridge all face pressure when crude declines. The Canadian dollar typically weakens alongside oil, which creates a compounding effect for Canadian investors holding U.S.-listed stocks. The silver lining: a weaker loonie means your U.S. dollar-denominated holdings are worth more in CAD terms. But for direct energy exposure on the TSX, today is a caution flag. The father of modern value investing, Ben Graham, would look at this situation and counsel patience. He would note that when an entire sector falls out of favor, the best businesses within that sector often become mispriced. Graham's approach would be to identify energy companies with strong balance sheets, sustainable dividends, and the ability to weather a temporary downturn. If Iran peace deal drives oil lower over the next few weeks, quality Canadian energy names could become compelling value investments for those willing to look through the cycle. Healthcare weakness presents another opportunity for value-oriented Canadian investors. Pfizer dropped another 3.02% today and is now trading at fresh multi-year lows. The stock sits just above $25 with a dividend yield exceeding 6%. The market is punishing Pfizer as its COVID-19 vaccine and treatment revenues fade, but the company has a deep pipeline of non-COVID products and an aggressive cost-cutting program underway. Eli Lilly also declined 2.72%, extending its recent pullback. For Canadian investors who hold U.S. healthcare stocks or own them through TFSA and RRSP accounts, the sell-off in Big Pharma creates an interesting entry point. The legendary Fidelity fund manager, Peter Lynch, would approach healthcare with a simple framework. He would ask, what is the story behind the stock and does it make sense? Pfizer's story right now is a company transitioning from pandemic-era revenue to a sustainable pipeline-driven business. Lynch would say that if you understand the products, if you can see the pipeline maturing, and if the sell-off looks overdone relative to earnings power, then the crowd is probably wrong. That is exactly the kind of scenario he built his career on. Let's talk about cybersecurity, because Palo Alto Networks' 5.78% gain deserves more attention. Cybersecurity spending is non-discretionary for enterprises, governments, and institutions. The threat landscape is worsening, and AI is creating both new defense tools and new attack vectors. PANW is the bellwether for this space. Canadian banks, telecom companies, and government agencies are all customers. The cybersecurity theme is durable, and Palo Alto is the 800-pound gorilla. Also worth noting, Oracle gained 0.7% today, continuing its quiet but steady climb. Oracle's cloud transition is working, and its database monopoly gives it pricing power that most tech companies can only dream of. The world's leading innovation-focused fund manager, Cathie Wood, would be watching Oracle not for its legacy database business, but for its autonomous database and cloud infrastructure platform that powers AI workloads. She looks for exponential growth potential, and Oracle's cloud revenue trajectory, while not as flashy as the hyperscalers, is accelerating. One final sector worth discussing, streaming and entertainment. Roku gained 2.3% today. The streaming platform company has been volatile, but its ad-supported model is gaining traction as more viewers cut the cord. Roku's operating system is in millions of smart TVs across North America, including Canadian households. The platform monetization story is not fully appreciated by the market. Roku is positioned to benefit from the shift of advertising dollars from linear television to streaming, a trend that is accelerating in Canada as well as the United States. For Canadian investors looking for a high-growth, high-volatility name with a structural tailwind, Roku fits the profile. Now let's translate all of this into actionable stock picks for Canadian investors after today's close. These are names you can research in your TFSA, RRSP, or margin account through your Canadian brokerage. First pick, Cisco Systems, trading at $96.57 after today's 4.96% gain. Cisco is the backbone of the Internet. Every Canadian enterprise, every bank, every government agency uses Cisco networking equipment. The AI data center build-out requires massive upgrades to networking infrastructure, and Cisco is the default supplier. He would approach Cisco as a company he understands. He would look at the product, the customer base, the competitive moat, and the long-term demand driver. Cisco checks every box. The dividend yields about 2.7%, the balance sheet is pristine, and the AI networking tailwind is just getting started. This is a high-quality business at a reasonable valuation that benefits from the structural trend in AI infrastructure spending. Second pick, Pfizer at $25.68, down 3% today and at new lows. This is the value play of the day for Canadian income investors. He would look at Pfizer and see the classic margin of safety. The stock trades at roughly 10 times forward earnings. The dividend yield is over 6%. The company is cutting costs, buying back shares, and has a pipeline of drugs that will generate revenue for decades. The market has thrown it out with the bathwater, but Pfizer is not a broken company. It is a blue-chip pharmaceutical giant trading at distressed prices. For Canadian investors who want defensive income with upside optionality from the pipeline, Pfizer at $25 is a compelling proposition. Third pick, Oracle, at $195.95, up 0.7% today. Oracle is often overlooked in the AI conversation because it is not a hyperscaler like Amazon or Microsoft, but its cloud infrastructure business is growing rapidly. Oracle's database monopoly gives it a unique position in enterprise technology stacks. He would study Oracle's cloud revenue trajectory and recognize a company in the early stages of a multi-year transformation. The database business generates enormous free cash flow, which funds the cloud expansion. Canadian enterprises running Oracle databases are locked into the ecosystem, creating a durable competitive advantage. This is a growth at a reasonable price story with AI tailwinds that most investors have not fully priced in. Fourth pick, Roku, at $129.53, up 2.3% today. This is the highest risk, highest reward pick in today's lineup. She would look at Roku and see a platform company riding the secular shift from linear TV to streaming. The ad market is massive, and Roku's operating system reaches millions of households. The company is investing aggressively in content and technology, which depresses near-term earnings but builds long-term competitive advantage. For Canadian investors with a higher risk tolerance and a 12-month plus time horizon, Roku offers exposure to the streaming transformation at a valuation that is reasonable relative to the total addressable market. The bottom line for May 8th, this is a semiconductor-driven market. The tech rally is real and structural, but the narrowness is a warning sign. When only one sector works while everything else falls, the market is telling you that capital is rotating aggressively, not that everything is fine. For Canadian investors, the right approach is to stay diversified but overweight the themes that have durable tailwinds: AI infrastructure through Cisco, value income through Pfizer, cloud transformation through Oracle, and disruptive streaming through Roku. Energy stocks may get cheaper before they get better if the Iran peace deal advances, but quality names will be buyable at lower prices. Keep some cash ready, focus on quality, and ignore the daily noise. This has been your May 8th Market Close Recap. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.